Bonjour tout le monde, je m'appelle Paul Bodicher et c'est un plaisir de vous accueillir à cette conférence de presse. Good afternoon, everyone. Thank you for joining us for today's press conference with Governor Tiff Macklem. Governor Macklem will be pleased to take questions for about 20 minutes, but before we get to your questions, some quick housekeeping notes. I'll ask everyone to please limit yourself to one question and a quick follow-up so that everybody who wants to ask a question can do so. I'll also ask everyone to kindly make sure your line is muted. If you're not asking a question, you can do so by pressing *6 and unmute by pressing *6 again. Pour mettre votre ligne en mode discrétion, appuyez sur *6 et pour l'enlever, faites *6 encore une fois. Et bien sûr, libre à vous de poser vos questions dans la langue officielle de votre choix. And if I fail to identify you when I call on you, please state your name and affiliation. So with that, we'll get going, and our first question is going to be Dave Parkinson of the Globe and Mail. Dave, go ahead, please.
Thanks, Alex. Good afternoon, Governor. Sorry, I'm getting an echo on my line. I apologize. In the speech, you obviously talked a great deal about the need for productivity, enhancing investment, not a lot about what public policy can do about that. Obviously touched a little bit on what the bank itself does to sort of set the stage for it, but is there a role, a significant role here that you see for government policy in terms of stimulating or encouraging the kind of investment that you're talking about? And is that something that's been missing from the equation over the last, frankly, decades?
Well, I was speaking to a business audience, Dave, so my remarks were principally addressed to the business community. I certainly did underline that there is a shared responsibility, and governments certainly have an important role to play. Governments have played a very important role in getting us through this pandemic at the provincial, at the federal level. Monetary policy has also played a critical role for the and certainly. When you look at government policies, their emergency support programs have wound down as the pandemic has receded and people have got back to work. Monetary policy has also wound down, and as we announced a couple of weeks ago, we've now moved off all our emergency policy settings. With respect to the go forward, look, I'm going to leave government policies to our elected officials, but I think, the one thing, the core message to business was we need to build supply capacity in our economy. Investment productivity is critical to growing our economy while getting inflation down. If we don't get that productivity growth, if we don't get that investment, we won't be able to grow the economy as much and get inflation back to target. And similarly, I think public policy needs to focus more on the supply side, and whether it's the supply of housing, the investments in key infrastructure to move goods across this country. There are particularly as the economy now is back to capacity, then there is a greater need to focus on the supply side, both in government and in business.
And on that note, do you feel like there's been a tendency for business in this country, and you've talked about how we have underinvested, at least compared to our American counterparts. Has there been an inclination by the business community in this country, you think, to lean more on labor investment as opposed to capital investment?
So in Canada, we have grown more by hiring people. And you know, that has been good news in many respects. We have higher rates of labor market participation. We have a more inclusive economy. We've created a lot of jobs for Canadians. I think as we look forward, labor markets are tight. Companies are having a hard time filling all the vacancies. Our population is aging, so that means the new generation of workers coming into the labor force is smaller relative to the generation of workers, the baby boomers that are retiring. So our labor force growth has slowed and is going to continue to slow. So what that means going forward is to achieve the kind of growth that we're aspiring to as a country, and to achieve the rising standards of living that we're all hoping for, we're going to have to rely more on productivity growth going forward and less on labor force growth. We're certainly going to need both, and there's room for both, but we're going to need relatively more productivity growth to sustain growth in GDP.
We'll go now to Michelle Zadikian of BNN. Michelle.
Hi there. If business investment starts to weaken as the rate hiking cycle gets underway, would you pause further rate hikes?
Well, first of all, let me just underline, there are a number of good reasons to expect business investment to be quite strong. I think, first of all, the table is set. Business balance sheets are generally healthy. Businesses are reporting to us that they are running up against capacity constraints. If they want to meet demand, they're going to have to add to capacity. Consumption growth is growing robustly. Our exports to the U.S. are strengthening. And perhaps most importantly, when we go and ask companies about their investment intentions, they're strong. In fact, they're stronger now than they've been since we started our bank business outlook survey in 1999. So, over 20 years ago. It's the strongest it's been. So I think we have every expectation that we are going to see solid business investment growth. In terms of, we've been very clear with Canadian businesses, interest rates are ultra low. The need for ultra low interest rates has passed. Businesses, Canadians can expect interest rates to be on a rising path. When you talk to businesses, and you can see this empirically, the biggest thing that drives investment is the opportunity. If there is a business opportunity, there is an opportunity for future profit. That's what drives investment. And in an economy that is growing, in an economy that where businesses are hitting capacity constraints, that is the major thing that is going to drive investment. With respect to our own monetary policy, certainly we will be looking at investment. We will be looking at productivity. But we will be looking at everything else as well. Ultimately, our interest rate path will be driven by what it takes to bring inflation back to target. Productivity and investment is one and an important input to that outlook, but it's not the only input.
Michelle, did you have a follow-up?
Thank you. I do, yes. And then do you have any comments on the economic impact of the blockades of the Ambassador Bridge?
Well, I guess the first thing I'd say, somebody who lives in Ottawa in particular, the certainly the blockade is very distressing for residents of downtown Ottawa, and many of our own Bank of Canada employees live in downtown Ottawa, and I've certainly heard from them they are being affected. With respect to our own operations, our head office is in downtown Ottawa on Wellington Street across from Parliament, and the blockade is certainly making access to the building difficult. Most of our employees are already working at home due to the pandemic. Given the difficulties in accessing the building, we have restricted the building to only the most essential workers. We have a second site in Ottawa. We have a major operation in Calgary. We have offices across the country: Halifax, Montreal, Toronto, Vancouver. So we are operating as normal out of those offices. So at least for us, while the blockade is inconvenient, we're fully operational. For the economy more broadly, really the issue is if there were to be prolonged blockages at key entry points into Canada, that could start to have a measurable impact on economic activity in Canada. We are seeing blockages at the Ambassador Bridge in Windsor, Coutts in Alberta. So far, they haven't lasted very long, but if they were to last longer, that would become a concern, a bigger concern. Look, most truckers are trying to get goods in and out of Canada. I do hope these blockages can end quickly. We've already got a strained global supply chain. We don't need this. I think Canadians are looking to buy goods. Canadian businesses are looking to export goods. And I think the sooner we can get this resolved, the better.
We'll go now to Greg Quinn of Market News, please.
Hello. In a very rough sense, you're moving towards tightening monetary policy. While you can see comments from the Prime Minister talking about having Canadians backs until the pandemic is over, suggesting more deficit stimulus. How do you ensure that the public doesn't see fiscal and monetary policy potentially pulling in different directions?
Well, I guess from our perspective, we have a clear mandate, Greg, and the need for emergency levels of monetary policies report have passed. Our economy has recovered from the pandemic. The pandemic is still out there, and certainly certain sectors. We're well aware that if you're in international tourism or arts and recreation, it may not feel like the economy is fully recovered. But when you look at the economy overall, what we see is a labor market that has recovered. Employment is above pre-pandemic levels. People have come back into the labor force. Wages are rising. Companies are reporting high levels of labor shortages. Vacancies are very elevated. So, there is a broad range of indicators that suggest that slack has been absorbed. The need for emergency level monetary policy has passed. And so we have signaled very clearly to Canadians that interest rates will be on a rising path. That path, the steepness of that path, the slope of that path, how much we have to raise interest rates, those are decisions that will be taken at each decision point, and we will be certainly updating Canadians on our outlook for the Canadian economy as we go.
Thank you. Secondly, other central banks that have used major quantitative easing programs buying up government bonds, they often haven't returned their balance sheets back to where they were before they started the program. I mean, this is Canada's first time with full-on QE. Do you think we'll make more progress than other nations have done in dialing back the holdings of government bonds?
Well, it's hard to speak for other central banks, so let me talk about what we've done and what we've said. So, when we launched quantitative easing, we said we would continue until the recovery was well underway. As you're well aware, as the recovery progressed, we began tapering, and we ended QE in October, entered the reinvestment phase, and in January we indicated that. When we increase the policy interest rate, we will be considering exiting the reinvestment phase and moving to what some people call quantitative tightening, which means allowing your balance sheet to run down. So we wouldn't be replacing the bonds that are maturing. We are not actively contemplating actually outright sales of government bonds, but once we lift off the policy rate, we will be considering exiting the reinvestment phase and allowing our balance sheet to shrink. With respect to the broader use of these extended monetary policy tools. The Bank of Canada came in very forcefully at the outset of this crisis. That was really important, and together with vaccines, with fiscal policy, it has worked. The Canadian economy has recovered. The other part of coming in force, though, was from the beginning being clear about the conditions for exit, and we have been clear from the start of the conditions of exit, and we have been exiting, and we've now removed all our emergency policies, and an important element of sort of completing this first use of quantitative easing will be to when the time is right, let the balance sheet move down and get back to more normal levels. So yes, that is certainly something that is coming.
We will turn now to Julie Gordon of Reuters, please.
Hi, Governor. Thanks for taking our question. Given the lagged effect of monetary policy, any regrets on holding off from removing extraordinary forward guidance until you were certain that the output gap had closed, particularly as the supply pressures were already impacting inflation?
We were very clear in our decision in January. We removed the last piece of our extraordinary emergency policy measures, and we signaled very, very clearly to Canadians that they should expect interest rates are on a rising path. Why do we do that? There's really two important reasons. First, slack we judge that slack now is absorbed. The inflation we're seeing now is not reflecting generalized excess demand in the economy, but slack is absorbed, and growth in spending has considerable momentum. So we need higher interest rates to dampen spending and bring it in line with supply growth. The other reason is that it's really important to keep longer run inflation expectations well anchored. Longer run inflation expectations, medium-term inflation expectations are well anchored. Not surprisingly, with the rise in inflation to close to 5%, near-term inflation expectations have risen, and our own forecast has inflation staying around 5% through the first half of this year, and that's frankly reflected in these short-term expectations. What we don't want to see, though, is that increase in short-run inflation expectations migrate into medium and longer-term inflation expectations. If inflation expectations become unmoored, it will become much more difficult to get inflation back to target. And those are the two key reasons that motivated us to be unusually clear that we effectively announced a major shift in monetary policy, and I think in the coming months you will see that implemented.
Okay, thank you. And then just turning to the housing market, I mean, you expressed some concerns about Canadians overextending themselves. And, certainly in the last few weeks, in addition to an already hot market, we've seen a real frenzy taking place, and not just in the main cities, but also in the secondary cities. I mean, how crushing of a situation could this be for the Canadian economy?
Housing activity is certainly elevated. Housing prices have been rising quickly, and that is impacting CPI inflation through the shelter component in the CPI. With respect to activity in the housing market, look, we've had a vulnerability in our housing market for some time, and it certainly predates the pandemic. We've been highlighting the vulnerability, the combined vulnerability caused by high levels of household indebtedness and high housing prices for some time. The pandemic, the unique circumstances of the pandemic have exacerbated that. Because of public health restrictions, we've all been spending a lot more time at home. Naturally, people want more space. We've seen demand for single-family homes, particularly outside or in the suburbs of major urban areas. We've seen a real surge in demand, and construction has not been able to pivot and keep up with that. And that's been reflected in big increases in prices. As the pandemic recedes, hopefully we'll all be able to get out of our houses a bit more. We expect to see that pandemic-related demand start to come off. And also by signaling that interest rates will be on a rising path, that should have some dampening effect. So in our own forecast, we do expect housing activity will moderate. But having said that, we do expect it's going to remain at really quite an elevated level. Job growth is strong, wages have been going up, incomes are growing in Canada, immigration is rebounding, so there are certainly some elements of sustained demand in housing. And I think that really points to the importance of the supply side. And I am pleased to see both at the provincial level and at the federal level of governments more focus on the supply of housing. We've really been in this situation now of ebbing and flowing in the housing market, but sort of sustained strong demand for almost a decade. And I think that really does point to the need for more focus on supply, and I'm pleased to see that is underway.
Next, we've got Eric Hertzberg from Bloomberg, please.
Afternoon, Governor. What are the implications for the interest rate tightening path if businesses don't pick up spending and capacity doesn't accelerate at the pace you're expecting? How key is this investment recovery in the bank's near-term action?
Well, as economists like to say, everything else equal. If productivity growth is weaker, that means we're going to have less growth in potential output in the economy, less expansion of our supply capacity. And other things equal, that means that interest rates would have to go up more. So in taking the decision that we took to remove emergency policy measures and signal a rising path for interest rates, as I outlined, an important reason for that is we need to bring the output gap is closed, there is strong demand. We need to dampen demand for spending and bring demand in line with supply. You have to look at both the demand part of that and the supply part of that. So the more we can increase supply, the more the economy can grow without inflationary pressures. Our goal is very clearly to bring inflation back to target, and the interest rate path that we decide on as we move forward will reflect our outlook for inflation and how well it is, in fact, coming back to target.
Thanks. And following to that, can you give us an update on your thoughts regarding the neutral rate? of interest. What's your estimate for the end point of the hiking cycle, and is that evolving?
So the neutral rate. So the neutral rate is it's something that we can't observe directly. I think it's certainly lower than it was in the first decade of inflation targeting, but exactly where it is a hard thing to be very precise about. When you do a forecast, you have to put an estimate in. We have a range of about, which is a range of 1 percentage point, which is centered on 2.25 or 2.25%. That sounds very precise. I want to dissuade you of the view that we can be that precise about it. But that's what it is. I mean, that's our estimate in our model, in our projection. I think what I would emphasize is one of the key features and one of the benefits of an inflation target is that as we raise the policy rate and bring inflation back to target, we're going to see how the economy evolves. We're going to see how the economy reacts to higher interest rates, and as we see that, we'll learn something about where that neutral rate is. It's even possible that we, for a time, have to raise interest rates above the neutral rate to get inflation back to target. On the other hand, if there are if there's new headwinds emerge in the Canadian economy, maybe we don't get all the way back to the neutral rate. Those are things we will see over time. I think what's clear right now is interest rates are at ultra low levels. The economy overall has recovered, and interest rates need to move up. How much they need to move up, how fast, and where they end up, those are decisions that we'll take through time as we learn how the economy is reacting to those interest rate increases.
Okay, moving quickly now, I've got two names left on the list. Ian Bickus of Canadian Press, please.
Thanks for squeezing me in here. Just quickly on the expectations for inflation and concerns about becoming unmoored. With so much coverage of it in wage rises and such, I guess just how concerned are you that it is becoming a midterm issue, or that people are seeing it as a longer term issue? How close are we to getting to that point?
It is a concern, and I think what Canadians are experiencing is we've seen some broadening of the inflationary pressures across a broader range of goods. So, it started in a fairly narrow set of internationally traded goods and energy. It is now spread to, it's worked through transportation costs. It's spread to a broader set of goods. It's also spread to food prices. Part of that are higher costs of transportation. Part of that is also there have been some in Canada. We've had floods, we've had droughts. Other parts of the world have also had some adverse weather conditions that has increased food prices. So there's no question that Canadians are seeing inflation on a broader set of goods, and that certainly can start to influence their psyche. That's why it's been very important for us to get out and signal very clearly that we are not comfortable with where inflation is. Inflation is too high, and we will be bringing it down. It is going to stay, unfortunately, uncomfortably high through the first half of this year. We expect probably close to 5%. In the second half of the year, though, we do expect it to come down relatively quickly to about 3% by the end of the year, as the pandemic eases, as these global supply issues that have been driving this big increase in the price of goods recede. You'll see it come down. And we've signaled that to get it the rest of the way back down to the target, we are going to need higher interest rates. And I think by signaling very clearly to Canadians our commitment, our intention, and our actions, I really hope that that assures Canadians that they can be confident that inflation will come back to target.
Right. And then quickly, you talk about businesses need to invest more in hardware and such, but how much of an inflationary pressure will that have in the short term?
Well, you're right that increased investment demand creates demand in the economy. But the other thing that investment does is that if you give workers better tools, better equipment to work with, workers become more productive. What that means is that the economy can pay higher wages without causing inflation. It means there is more capacity to grow with the same number of workers, and that actually puts downward pressure on inflation. So while there can be a timing issue, the investment and productivity are actually essential to sustaining growth and bringing inflation down.
And finally, we'll go to Mark Rendell of the Globe, please.
Thanks so much for squeezing me in at the end. Hi, Governor. Was wondering, you seem quite optimistic about business investment, and I'm wondering how much investment in the energy sector plays into that, and whether you see the kind of rebounding price of oil being a big driver of business investment.
So with respect to oil and gas, we do expect, particularly with prices as high as they are, we are expecting some pickup in investment, but we're not expecting as much a pickup as we have seen in the past. And that really reflects, I think, the global transition to cleaner sources of fuel. And so the investment response we are expecting is more muted in oil and gas than what we've seen in the past for the kind of prices we're seeing today.
And just following up on that, how important is, I guess, being clear about what the transition to net zero by 2020 or 2050, the steps around carbon taxing, carbon border tariffs, how important is it to be very clear about those things, their sequencing, if you're going to convince companies to invest in potentially carbon-intensive industries?
Well, certainly, in Canada, I think the clarity around the carbon tax is very helpful. I think Canada globally is among the leaders in this, and I think more clarity around carbon taxes around the world would be helpful. I think economists certainly see this as the clarity around the price of carbon is helpful in spurring the rotation that we have to see around the world. With respect to the Bank of Canada, we have been doing a fair amount of work on this. Look, there is a lot of uncertainty. Clearly, we've never transitioned to zero carbon growth before. We've never addressed climate change before. But an important message is we can't be paralyzed by that uncertainty. And one way to try to address that is to use scenarios. So they're not predictions like our forecast, but they are plausible scenarios. And in January, we put out a range of plausible scenarios, and I'll just highlight two key messages that come out of that. First of all, while they're not projections, they're scenarios, what you see in all the scenarios is the Canadian economy needs to go through a considerable amount of adjustment. We do make, we have pretty conservative assumptions about technological change, and certainly more rapid technological change, more innovation in clean tech could help make that transition smoother. But certainly in all the transitions, there's a lot of adjustment that needs to take place, and that adjustment is on a scale that it has macro implications. And one of the things we're increasingly going to be working on is looking at what are the sort of macro implications. What do those mean for monetary policy? That's not something we're going to figure out between now and the next monetary policy decision, but it is something we're going to be working on over time. The other key message that comes through is that if we delay the adjustment, when the adjustment comes, it's more abrupt, it's more disruptive. There is a bigger risk of a rapid repricing of assets that could put stress in our financial system, which would make an already difficult adjustment potentially even more painful. So, the message is, the sooner we start and the more we can gain momentum, the higher the chance of a smooth adjustment path to zero carbon growth.
And that will conclude today's press conference. Thank you, Governor Macklem. Thanks to all the reporters for participating, and thanks to all of you for watching and listening. We'll see you next time.